Trend lines are one of the most useful tools in trading, but many traders are still using them incorrectly. One of the biggest challenges with using trend lines is knowing how to draw them correctly. Some people draw trend lines connecting the candle wicks, while others use the candle bodies. So which one is right? Then there is the next question. Even if a trend line is drawn correctly, how do we actually trade it? Do we enter when the price touches the trend line, expecting a bounce? Or do we wait for the price to break out, expecting a reversal? In this video, we'll go through all of these questions by breaking down how to draw and trade trend lines in less than 10 minutes. What is a trend line? A trend line is a straight line drawn on a chart that connects two or more important price points called swing points. Markets don't move in a straight line. Price constantly moves up and down, and with so much movement, it can be hard to tell where the market is really going. To make this easier, we draw a trend line. A trend line helps remove the noise by visually showing whether the price is generally moving up or down. When a trend line slopes upward, it tells us the market is in an uptrend. When it slopes downward, it tells us the market is in a downtrend. Since trend lines are created by connecting swing points, the next step is learning exactly which swing points to use and how to draw a trend line. How to draw trend lines. To draw a trend line, the first step is to find swing points on the chart. A swing point is a point on the chart where the price changes direction. When price moves down and then turns back up, that turning point is called a swing low. When the price moves up and then turns back down, that turning point is called a swing high. Our job is to find as many swing points as we can on the chart. In this example, we can see several swing lows, but we should only mark the major and obvious ones. If a swing point is easy to spot, it's usually important. To draw a trend line, we need at least two major swing points. Once we find them, we draw a straight line connecting those 2 points. That line is the trend line. A common question is whether to draw the trend lines using the wicks of the candles or the bodies. This is the part where most people get confused. The simple rule is this: use whichever gives you more touch points. In this chart, if we draw the line using the wicks, we get 3 touch points. But if we draw it using the candle bodies, we get 5 touch points. Since more touch points make the trend line stronger, we use the candle bodies here. Another important thing to remember is that trend lines are not exact. They should be treated like an area, not a perfect line. So it's okay if your line is slightly higher or slightly lower. As long as it stays near the swing points, the trend line is still valid. Don't overthink it. Once a trend line is drawn correctly, it starts giving us useful information, not just direction. And this brings us to the next question. Why do we use trend lines? You might be wondering, can't we already tell where the market is going just by looking at the chart? So why do we even need trend lines? The answer is simple. Trend lines do more than show direction. Now, there are 2 main reasons why we use trend lines. The first one is this. Trend lines help us find trade opportunities. When we draw a trend line, we often notice that price reacts to it. For example, in this chart, we draw a trend line by connecting the swing lows. Notice how price bounces up each time it touches the trend line. This tells us that the trend line is acting like support. Knowing this, if price comes back to the trend line again in the future, we can watch for a possible bounce and a potential buy setup. The second reason is, trend lines can warn us about a possible trend change. Trend lines can also help us spot when a trend may be changing. For example, in this chart, we draw a trend line by connecting the swing highs, which shows that the market is in a downtrend. But when the price breaks above the trend line, it can be an early sign that the downtrend is losing strength. Sometimes this break leads to a full trend change from a downtrend to an uptrend. This is why traders pay close attention when price breaks a trend line. So now that you understand why traders use trend lines, let's look at 2 simple trend line strategies you can explore today. Strategy 1. Trend line bounce strategy. In this strategy, trend lines are treated as important areas where price may react. Price often respects a trend line and bounces from it in the direction of the trend. Let's start with an uptrend. First, look for a market that is clearly moving upward. In an uptrend, price keeps making higher highs and higher lows. Once we identify this, We draw a trend line by connecting the swing lows. This trend line acts like a support area. Now we wait. When price pulls back and comes close to the trend line, we look for confirmation, another sign that the price is likely to bounce. One simple confirmation you can use is a bullish engulfing candlestick pattern. This happens when a large bullish candle completely engulfs the previous candle, showing that buyers are stepping back in, pushing the price higher, and respecting the trend line as support. Once we see this confirmation, that's when we look for a buy trade. For risk management, we place our stop loss slightly below the recent swing low. For our take profit, we target 2 times the size of our stop loss. Now let's look at the opposite situation. First, we want a market that is clearly moving downward. In a downtrend, price forms lower highs and lower lows. Once we identify this, we draw a trend line by connecting the swing highs. This trend line now acts as resistance. Next, we wait for the price to pull back toward the trend line. When the price reaches this area, we don't enter immediately, but wait for another confirmation. This happens when a large bearish candle completely engulfs the previous candle, showing that the sellers are stepping back in, pushing the price lower and respecting the trend line as resistance. Once we see this confirmation, that's when we look for a sell trade. For risk management, we place our stop loss slightly above the recent swing high. For our take profit, we target 2 times the size of our stop loss. Now let's look at another trendline strategy. Strategy 2, trendline breakout strategy. This one focuses on trading breakouts. The idea is simple. When price breaks above a trend line in a downtrend, it often means the trend is changing from down to up. But the problem is, not every breakout is real. Sometimes price breaks slightly above the trend line, making it look like a new trend is starting, and then quickly falls back down. This is called a false breakout, and entering too early can lead to losses. So instead of rushing into a trade, we need a better way to confirm that the breakout is real. Let's walk through the setup. First, we look for a market that is clearly in a downtrend. In a downtrend, price keeps making lower highs and lower lows. Once we see this, we draw a trend line by connecting the swing highs. Next, price moves above the trend line. At this point, we still do nothing. A breakout by itself is not enough. What we want to see now is a confirmation that the downtrend is losing strength. One simple way to spot this is by looking at how price forms its lows. In a strong downtrend, price keeps making lower lows. But once sellers start losing control, price fails to make a new lower low and instead forms a higher low. This higher low is important because it shows that selling pressure is weakening and buyers are beginning to step in. Now comes the final confirmation. Since trend lines are treated as areas, not exact lines, we want to see a strong candle close above the trend line area, not just a brief move above it. A clear close above this area confirms that the breakout is valid and that the trend is likely shifting. Once we see both conditions, a higher low and a strong close above the trend line, we can look for a buy trade. At this point, the breakout is much more likely to be real. For risk management, we place our stop loss slightly below the trendline breakout area. For our take profit, we target 2 times the size of our stop loss. The main idea behind this strategy is confirmation. Instead of trading every breakout, we wait for price to show weakness in the old trend and strength in the new direction. This helps us avoid false breakouts and enter trades with more confidence. If this helped you understand how to draw and trade trend lines more clearly, make sure to like the video and subscribe to the channel for more simple, practical trading lessons.